Good evening, everyone. I hope you're doing well. I hope you're enjoying the inflation crisis we're going through. There's some concerning theories out there at the moment. I'm going to talk about why I disagree. But the theory from a lot of mainstream economists, financial commentators, is that interest rates or monetary policy doesn't work anymore. That we've got this inflation problem. We've raised interest rates, and interest rates are a blunt tool that don't work anymore. And that's not true. We're not using interest rates correctly. But let me just first show some of that evidence, and then we'll look at some data, and I'll give you my contradicting thesis. Firstly, from one of Australia's top economists and former advisor to the Prime Minister, monetary policy, so the Reserve Bank of Australia adjusting interest rates, is losing its potency. No, it's not. We're just not doing it correctly. It doesn't have any potency because it's being done in a very weak way. And I'll show data, I'll show reasoning for that. Whether we look at, Channel 9 news reporting on, what the RBA governor has said, that people often say to me, the Reserve Bank of Australia governor, you must have a better thing than the interest rate. And she says, we don't. It's all we have, and we know it affects different people differently. Correct, but there needs to be context. Of course, the Australia Marxist Institute has been talking for years about why interest rate increases don't work. They do, but from them it's all about, the greedy 1% are getting all these tax breaks. I've already made a video about that recently, which I've linked in the description below. If you want to look more specifically at the housing market, I did a 41-minute breakdown on that, starting with, Green Senator Nick McKim and some of the incorrect information that he was putting out. And then, of course, the Sydney Morning Herald reporting that the Reserve Bank of Australia needs sharp tools, not a rates blunt axe. So interest rates are a blunt tool, they don't work, and that's just not correct. So I'm going to show interest rates and relationships to inflation in a sec, but just briefly, what a lot of these economists think, and if you went to university and learnt about economics, what they would tell you is that they raise interest rates to slow demand. So if interest rates are higher, people spend less money. If spending slows, well, then inflation comes down, and that's it's somewhat correct on the surface. But where is that extra money that people are spending coming from? It's coming from low interest rates, from banks creating thousands of billions of dollars worth of loans, sending out newly created dollars into the economy. And I'll show you that in a sec. So firstly, interest rates. So they talk about, one of Australia's top economists saying that, interest rates, which is monetary policy, is losing its potency. No, it's not. We're just not doing it correctly. This is a chart going back to 1991, and it shows the interest rate in Australia. Very simple chart, just the interest rate. It was at 17.7 or 17.5% in 1990. And you can see that, yes, we've raised interest rates, but the trend across, what's that, 35 years has been to lower interest rates. But here's where it gets worse, and it's going to get worse again after that. Something you can do if you've got TradingView is that you can use formulas. So what's important is not the interest rate, whether it's 4.35% now, which is known as the nominal interest rates. So whenever you turn on the news and they say the RBA lifted interest rates to 4.35%, that's the nominal rate. That's not the real interest rate. The real interest rate is the rate that the RBA sets, or any interest rate that we're talking about, minus inflation. So I'm sure a lot of you watching this video have plenty of common sense. If inflation's 5% and you're saving money in the bank, don't you want to get 7, 8% interest? Because if you're only getting 5% interest, right, if you put $100 in the bank today and you get 5% interest, you have $105 next year, but now you need $105 to buy the same amount of stuff. And you have to pay income tax on the $5 of interest you earn. So you're actually going backwards. You have more dollars, but you don't have more wealth. So it doesn't matter so much what the actual interest rate is. It matters what the interest rate is compared to inflation. And historically speaking, and we'll look at some RBA data, they think the number's a bit lower, but my research suggests that interest rates have needed to be 2 to 3% above the rate of inflation to keep inflation running at about 2% a year, which I don't know why we would want constant inflation, but that's been the historical norm. So what I'll do is come back to this chart of Australian interest rates, and this is something you can do in TradingView. You can go to, so we've got this, I don't want to compare symbol, I want to click on the symbol, and if I go minus inflation, and I've filtered it to Australia, we've got the inflation rate year on year, and then we just click on that and hit enter. Now we've got one of my old charts with a bunch of notes on there, and I'll turn it off. I'll turn off those notes because we're going to talk about hide drawings. There we go. So now we've got the RBA interest rate minus inflation. So you can see from 1990, real interest now, that's because coming out of the 80s, there was a massive inflation problem. I understand that was, maybe we'll take that off the chart just so people don't accuse me of of using extreme examples. But if even through the mid 90s, you can see real interest rates were about 4%. And if we draw the zero line here, so let's just draw a zero line across there. Actually, that's going to bring my drawing tools back on. We don't need that necessarily. But what you can see is that clearly the trend in interest rates has been down. All right, and we'll hide that again. But the problem is, like, look where interest rates are right now. So even though we've raised interest rates, we have a big inflation problem. So we've got, you might think, oh my God, the RBA's jacked up interest rates, and they have, but real interest rates are still negative 0.5%, meaning inflation is 4.6%. Uh, that's the official government number. I think this chart has not yet updated to the latest RBA rate increase, but RBA's got rates at 4.35%, inflation is 4.6%, meaning inflation is still higher than the RBA interest rate. Interest rates need to be up here, 1.5%, 2% above the rate of inflation. And that's where they were all through the 90s, all through the 2000s, apart from a couple of brief moments where they were cut because we had the dot-com bubble burst, the September 11 attacks, massive recession. They were briefly down there. And now look at where they are today. They're pretty much at the same level as they were at in a global emergency. Then here, this was 2008, the global financial crisis, when everything was in crash mode and the RBA and other central banks slashed interest rates almost to zero, depending on which country we're talking about. And then, of course, COVID was, I've talked in many videos before, we won't focus on the pandemic lockdowns, but this is where they did so much damage, taking interest rates ultra negative, and we're now experiencing the long-term consequences. I mean, that's not the only reason, but that's part of it. But so the first point I would make is that they talk about interest rates being a blunt tool. They're not a blunt tool. We just don't have interest rates high enough. Now, I would prefer there to be no central bank, let the market set interest rates based on the supply of savings versus the demand for borrowing, but we're never going to get that. The RBA is going to be with us. So to the extent we have the RBA, inflation's 4.6%. Interest rates need to be a lot higher. You only got them at 4.35. You're raising them very slowly. Whenever there's a crisis, they have emergency meetings. They immediately slash interest rates. So what I want, I guess the first principle I'd like you to be aware of, hopefully teach you or help with your education when you're watching this video, is nominal rates versus real interest rates. It doesn't matter. I mean, if inflation's 20% and interest rates are 12%, 12% interest rate is still too low, right? It's interest. The important number when it comes to interest rates is what is it compared to inflation. So the second point I would make is that banks create dollars. So if interest rates are low, more people can borrow money to buy a house, to buy a car, although in Australia, the bulk of the loans are to buy houses. So when banks make loans, they invent dollars. Despite what a lot of people may think, maybe some of you watching this video think the same thing, that the government prints money. Not really. About 95% of currency creation or creation of dollars is done by commercial banks, Commonwealth Bank, Westpac, NAB, ANZ. When you borrow $1.2 million from Commonwealth Bank to buy some crappy two-bedroom home in Sydney, those dollars are essentially invented by Commonwealth Bank. The loan is created, the dollars are created, they go to you, the money goes to the person selling the house, the real estate agent takes $20,000 or $30,000 for doing whatever they do for a ridiculous amount of money. The state government collects, depending on whether you're an investor or a owner occupier, they've probably collected $40,000 or $50,000 in stamp duty tax alone on that one transaction, and that money gets recycled. These newly created dollars get recycled back into the economy, and this is Australia's money supply, M3. And I've gone a long-term chart. Maybe I should zoom in 10 years because what happened in the 70s and 80s is not quite relevant to this conversation. But you can see in 2020, our money supply was roughly, so this is in thousands of billions, it was roughly 2.2 trillion, and now it's gone up nearly 60%. It's at 3.42 trillion. So all these new dollars have been created and gone into the economy, keeping in mind that there are a limited supply of physical goods and services, including houses. So when People, when interest rates are lower, more people can borrow larger amounts of money. When they borrow money, the dollars are created, and then the dollars go out into the economy, as per my earlier explanation. And that's where the demand comes from. So when these economists say, oh, we have to, historically raising interest rates would reduce demand, reduce spending, and that's what controls inflation, they're only counting the last step. They're not counting the currency creation that leads to the demand. And if interest rates were much higher, if interest rates were 12% in Australia, I'm not calling for 12% interest rates, but if interest rates in Australia were 12% right now, how many people are going to be able to borrow $1 million to buy a home in Sydney or Melbourne or Perth or Brisbane? Almost no one, certainly no regular people, right? So what would happen is fewer loans would be created, fewer dollars would be created, and this graph, instead of going up 60%, going from $2.2 trillion in existence when COVID hit in 2020 to 3.4 trillion Australian dollars in existence by this particular measure, 60% increase, we'd probably have the same money supply as we had in 2020. We would probably have the same cost of living, the same house prices as 2020, the same rents, roughly, right? I'm sure if you compared real estate prices to this money creation, which I would argue is a more accurate measure of inflation, you'd probably find real estate prices have been somewhat correlated with this dollar creation because most of these dollars that are being created are going into real estate. Secondly, so I showed that the RBA has not raised interest as yes, they've raised interest rates, but relative to inflation, they haven't raised interest rates enough. But another thing they did during COVID, this is their balance sheet. I've covered this in other videos, so I won't go too in depth, but essentially the balance sheet of the central bank of the Reserve Bank of Australia, in crude terms, measures how much money they've printed. So you can see from the 1990s until 2020, they, balance sheet was under $200 billion the entire time. That's the global financial crisis. That's how much money they printed in 2008. They went from 107 billion to 163 billion. So they only printed about $55 billion in the greatest global economic crisis in 100 years. That's how much money they printed. That little blip down there. Look at what they did during COVID. They printed about $450 billion. If you'd like to understand. Now they did that to, again, I'm giving an oversimplified explanation because I've covered this in depth in other videos. Please feel free to ask questions in the comments or message me on the social medias if you want to talk about it more. But essentially, that's the RBA spending lots and lots of money to suppress interest rates, which means super. Remember in 2020, you could get a mortgage for 2%. That's where a bunch of it came from. And that doesn't mean that $450 billion went out into the economy. That means $450 billion was going into the bond market and the banking debt market. So the government debt market, the banking debt markets. So that $450 billion can turn into 900 billion, 1.2 trillion, 1.5 trillion as banks make more loans to you to overpay for real estate and you go and pay someone else and they go and buy a different house and the fractional reserve banking, essentially the cycle continues, the money supply can be expanded exponentially. So, again, to say that interest rates, that monetary policy is losing its potency, it's not. Interest rates are too low and they printed too much money. If interest rates were well above the inflation rate, if inflation's 4.6%, if they set interest rates at 7 or 8%, we wouldn't have as much of a problem. Now, I understand there are consequences to that in the short term, but that doesn't mean it shouldn't be done. What we should never have, or the government should never have lowered interest rates and printed so much money in the first place. That's the problem. Raising interest rates now is that's the pain, the medicine that we have to swallow to undo the problems they created. But it gets worse than that because when I say the inflation rate is 4.6%, that's the government's official CPI number. Consumer Price Index, the CPI, is not the same thing as inflation. And I use this chart this graph as an example all the time because housing costs are a big part of the CPI calculation when the government reports inflation. And this is from 2020 to 2025. When the government measures rents, which are a significant component of inflation, and this applies to other things in the economy as well, the ABS, the Australian Bureau of Statistics, measures that over that 5-year period, rents went up about 18%, right? But when we look at rents that were advertised in the private market, they were up 45%. So they were rents went up more than double what the government is counting in their own inflation statistics, and that's because a lot of people get rent assistance or Centrelink payments, things of that nature. So the government says, well, same thing with the electricity rebates. In Queensland, we got $1,000 from the government on our electricity bill. So when we got that, you get your electricity bill and it's $1,500 and the government gives you $1,000 rebate, well, in the CPI calculation, they assume you only paid $500 for your electricity. The price of the electricity went up, but you didn't pay the full price because you got a government rebate. Therefore, it's not counted in the inflation number. So I would argue that the actual rate of inflation is much higher than that. So when I say that interest rates are, slightly real interest rates, so the RBA rate minus inflation is flat or negative, I would say it's even worse than that. If we counted inflation honestly, the RBA is probably still at negative 2%. So interest rates are way too low. Now, I understand that's going to hurt some people, and that's a whole other conversation. But to say interest rates are a blunt tool that doesn't work, because what they're doing is they're setting us up for, not they, sorry, that sounds ridiculous, but the we're being somewhat conditioned to this new climate that we're just going to have perpetual inflation that's above 2 or 3%, above an acceptable level, and we can't raise interest rates to stop inflation because the reason that the government and one of these economists are helping is debt levels are so high that if we raised interest rates to a high enough level to stop inflation, well, many governments would they'd struggle. And I've made other videos about this. The amount of debt that governments have, how are they going to pay the interest on their debt? Yeah. So now, if you think I'm just pulling this out of my ass, let's have a look at the Reserve Bank of Australia's official website. This isn't, you might be wondering, well, why haven't I heard about this concept of nominal interest rates versus real interest rates? And again, we're not being taught actual, helpful information about money and about how money works and interest rates work. Here is the Reserve Bank of Australia's official website, and here is the governor, Bernie Fraser. And you might say, who's that? Well, he was the governor back in the 90s, in 1991. He talked about 3 decades of real interest rates. Here he is giving a speech, providing research on real interest rates, on this concept. Ask yourself why you've never heard about this before, or if you have, credit to you for knowing about it. But you can see this graph now. They did these in the early 90s, so there's not much flair or color to them. Real interest rates. So they've taken the bond rate, which is a rate that's generally slightly above the RBA's rate in a normal market. But let's just forget about the nuance of the bond rate. Let's just say it's the nominal interest rate, the bond rate, adjusted for CPI. Notice how I assume this is 1 bar for every 5 years because it goes back to 1905. You can see there was a period of time during World War One where real interest rates were negative. That makes sense. There was a World War going on. I don't know what happened in that. That could be leftover stimulus from World War Two in the 50s there, but you can see for most of the last century, real interest rates at times were more than 5% above um, the inflation rate. And I asked the AI to help me average this out. It claims that the that over that period of time, the average real interest rate was 1.5%, meaning that interest rates were 1.5% above the rate of inflation, keeping in mind that 1.5% would be here, this line, and we haven't been, but that's 2012. For a brief moment in 2024, we were above that. But since 2012, we've basically had 14 years of real interest rates being lower than that average level that we had for 100 years, keeping in mind that through those times we had World War One, World War Two, the stagflation of the 1970s, which was a massive, and you could go both ways on that as to how that would impact interest rates. And that's if we go through a couple more charts, real interest rates. So this is short-term rates. It's hard to distinguish between Australia and G7 countries. You can see through the 70s, real interest rates were negative. And that led to massive problems. I'm not sure if you're familiar with the stagflation of the 1970s, but in other words, massive inflation with slow or sluggish economic growth or no growth, depending on which country and which time frame, the Federal Reserve in the United States had to raise interest rates in 1980, I believe they peaked. They had to raise interest rates to 20%, 20%, to stop the inflation crisis that they had in the 1970s. So, but you can see again, once the stagflation period ended, you can see real interest rates. That's the floor level. Look at how long interest rates were above. They were. That doesn't mean interest rates were 4%. That means interest rates might have been 8 or 9%, and inflation was 3 or 4%. Interest rates were like through that period from 79 to 1991 were averaging 4 to 6% above the rate of inflation. Again, this is from the RBA, long-term real interest rates, same thing. And then real interest rates, they're showing, the stagflation crisis. And that's what happens. I mean, when you that's why there was massive inflation in the 1970s, is because, well, partly, I'm oversimplifying it, but partly because central banks, government agencies allowed the inflation rate to go well above interest rates, and that's why we had these negative interest rates. So they would have been cutting rates because economic growth was slowing, but that meant they give up the inflation fight. So I've gone a bit long here, but hopefully you could see that I've made somewhat of a case that it's not that interest rates don't work, that interest rates are losing their potency. It's not that. And I understand some of you are now probably going to say, okay, well, what about the housing market? What about, all this negative gearing, capital gains tax, the migration, immigration, et cetera, et cetera. I understand those are all factors. This is a separate video related to interest rate policy versus inflation. And obviously, all those other factors like immigration, uh, you know, the situation with real estate ties into that. And that's why I've linked in the description below, or hopefully as a related video, a video I made a few days ago. Here's a screenshot here on all those topics. I did a deep dive for about 41 minutes. I understand that's a lot to watch, but hopefully that makes a bit more sense about what's going on with interest rates. And it's not that interest rates don't work, it's just that we didn't raise them high enough. And I don't want to have to jack interest rates up and hurt, you know, working families with mortgages. That makes me very sad. We should never have had 15 years of such low interest rates. 2008 was a significant moment for the global economy, where many things changed. And we're going to be, I mean, the damage that that's done, keeping interest rates way too low, governments letting inflation run to 6, 7, 8% before they do a little quarter% rate rise. But then, of course, when there's a problem, they have an emergency meeting and they slash interest rates really quickly, and they print in Australia hundreds of billions of dollars, globally trillions of dollars. And the reality is, and this is a topic for another video, generally speaking, high interest rates are better for poorer working class people like me and you, and they hurt richer people because, and this is a topic for another video, but just in case you're wondering, like, oh, well, John, why would you advocate for higher rates? It's going to hurt working class folk. Young working class people, they rent, they probably they're probably studying, or they work a minimum wage or lower paying job. They rent, so they don't own a home, they don't have a mortgage to pay. 33 to 35% of the country rents, and another 30 to 35% have already completely paid off their home. So raising interest rates has no impact on 65, well, not no impact, but has doesn't have a severe impact negatively on about 65% of the country. And that's the point that some of these people are making, is that, raising interest rates doesn't hurt they claim it doesn't hurt the wealthy or whatever. But the reality is, when you have interest rates too low and you have too much inflation, what happens is rich people who are on higher incomes, they have investments, so they have investment properties, they have stock portfolios, right? They don't It doesn't hurt them as much if petrol costs $20 a week more, or if groceries are $50 a week more expensive, if they've got three investment properties that have gone up $200,000 in price. Low interest rates create inflation, which boosts the asset price, the investment assets that richer people own, and it reduces the rate of interest they pay to borrow money to buy more of these assets. Conversely, the guy working at Coles or Woolies, or guy or girl working at Coles and Woolies, renting, living paycheck to paycheck, they don't have a mortgage, they don't have a stock portfolio or an investment portfolio. So when you lower rates, they can't earn as much on what little money they might be able to save. they don't see their asset prices go up because they don't have stocks or investment properties. All they get is the cost of living increase. And that's what low interest rates does to the working class. Anyway, I've gone too long with this video. If you made it this far, thank you so much for listening. Check out that other video if you're concerned about, or if you're interested in the deep dive on real estate and how that's impacting some of these issues we talked about. Talk soon. Cheers.